What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Friday, everybody. The weekend is almost upon us. Hope you've had a productive week and have a relaxing weekend planned. This week, Tsingshan Holdings Group Limited, a massive Chinese metal giant, indeed the largest private steelmaker in China and one of the largest in the world, is scrambling to manage massive losses from shorting nickel futures after the metal went on an unprecedented rally due in large part to the conflict in Eastern Europe. The firm came under mounting pressure to meet margin calls for its short position, which it built since last year, betting on a price decline for nickel. Losses are now in the billions of dollars for the company. As of the start of this week, the paper loss stood at $8 billion before violent moves in nickel prices, including the metal skyrocketing by as much as 250% in 2 days, led the London Metal Exchange to suspend trading in the metal on Tuesday. Losses for the company could be much higher. Financial media outlet Caixin reports that its industry sources say that Tsingshan was quote-unquote too confident as it didn't sell out of its short position in January, even though the market was quote-unquote clearly in favor of long positions, betting on a price rise, and quote, they didn't see the Russian-Ukraine conflict coming. End quote. The Shanghai Futures Exchange on Wednesday announced that it will suspend the trading of 7 categories of nickel futures for a day after they surged by the daily cap for 3 straight days. The metal surged by the daily limit of 17% on Wednesday. Tsingshan does have deep pockets, however, and is well connected, so it may yet survive. As for the leadership of the company, though, that may be a different story. Indeed, Tsingshan's billionaire founder, speaking to domestic media outlet China Business News, was happy to point out that the government would likely bail them out. Quote, "We've received a lot of phone calls today. Related government departments and leaders are very supportive to us. Tsingshan's position, operation and management has no problems." End quote. In the same statement, he was quick also to lay the blame for his poor investment decision, expressing, quote, "Foreigners have some activities going on against our position. We are actively coordinating to deal with the problem." End quote. By Thursday, Tsingshan Holding Group Co. won credit promises from banks including JP Morgan Chase & Co. and China Construction Bank Corp. after hours of meetings which went into the early hours. But then yesterday, Thursday morning, it was being reported that the founder has told the roughly 10 banks and brokers through which Tsingshan holds its nickel position that he still believes prices will fall and he would like to keep his short position. Now, the shockwaves of all of this massive mess from this week from Tsingshan are already being felt by other actors in the industry and in the global market. As of the filming of this video, the London Metals Exchange nickel market remains closed. The Japanese-owned UK-based Financial Times writes yesterday, quote, "The resumption of nickel trading on the London Metal Exchange will not quell controversy over Tuesday's unusual and disturbing halt to trading and cancellation of some trades. This will have spared some investors damaging losses, but the moves have infuriated some other investors who consider it favored a big Chinese company and its state-owned lenders. That puts the spotlight on the LME's ownership by Hong Kong Exchanges and Clearing, though the LME says that played no part in its response." End quote. Okay, next up, this week, the Mainland. Okay, next up, there's a People's Liberation Army plane flying over my location. Hopefully it's got nothing to do with this recording. We'll just wait a moment as it passes by. Okay. Okay, next up, this week the mainland is seeing its highest numbers of officially recognized cases since the original Wuhan breakout in late 2019, early 2020. Daily official cases were in the dozens 2 weeks ago. Now they are over 1,000, which is a lot for the mainland. Again, because China still maintains a very strict so-called dynamic zero COVID policy, even the discovery of just one case can result in a large-scale, expensive, and disruptive response. We are now seeing outbreaks across over a dozen provinces. Indeed, the list of provinces where the virus is not being discovered is shorter than the places it is. Currently, Beijing is still committed to maintain its dynamic zero COVID policy, but perhaps some loosening may be happening in the coming months. One Chinese Center for Disease Control official, this is the Chinese version of the CDC, speaking to state media, expressed 2 days ago, quote, "The policy will be adjusted in the future, but it will take time, and the key point is to find the right moment when conditions are ripe." End quote. On Wednesday, Chinese state-owned drug company China Meheco, MEHECO Corp, announced that it had secured a partnership with American drug company Pfizer Inc. to bring Pfizer's new COVID-19 pill to the Chinese mainland. The 2022 supply contract authorizes the commercialization of Paxlovid in China. Meanwhile, jumping from the mainland to Hong Kong, the situation in the Special Administrative Region remains very serious. The low vaccination rate among the city's elderly has driven Hong Kong's death rate to the highest in the world. Its 7-day rolling average of confirmed COVID-19 deaths as at the start of this week was 25.5 per 1 million people, more than 5 times that of the United States. Mainland-style citywide testing and citywide lockdowns are still being debated. On Wednesday, Chief Executive Carrie Lam expressed that compulsory citywide COVID testing is quote-unquote not a priority, but that, quote, preparation work and planning for mass testing will continue. End quote. Also, almost 2,000 Chinese contractors from China State Construction Engineering are in Hong Kong this week to build a makeshift facility near Hong Kong's border with the mainland, which is expected to provide 1,000 more hospital beds and quarantine rooms for up to 10,000 people, as Hong Kong's existing facilities are already well past 100% capacity. Okay, last up, as always, we're going to be looking at the property market, something we need to follow closely as the Evergrande crisis marches on. This is a months-long process and we need to follow developments day by day. If you're enjoying the content, don't forget to hit the like button, guys. It's always a massive help. Thank you, everyone, for all the support over the last few weeks and the last few months. You guys have been awesome. If you're watching for the first time and you're enjoying the content, I put up one of these every day. If you're enjoying it, maybe consider subscribing. You'll have the most up-to-date analysis when it's released every day. Okay, SOHO China is a major Chinese building developer, primarily in office and commercial buildings of the sector, but with also some residential interests too. SOHO has several high-profile office buildings and other hot property assets in Beijing and Shanghai. Indeed, most foreigners who have lived in either one of these cities should know SOHO buildings, and the video you're seeing now, you should see a SOHO building in the background. You see SOHO written at the top of the building. Very unique design. Yesterday, Thursday, the company announced that it will be selling prime properties in Beijing and Shanghai at a 30% discount and will use all the proceeds to repay its debts. According to Chinese financial media outlet Yicai, there are 9 projects, including both office buildings and residential apartment blocks, up for sale. The company will offer real estate agents a 4% commission on the transaction price, much higher than the usual commission for these types of deals. Now, the discount and the high commission tell us 2 very important things. First, SOHO China, like many developers, is facing acute liquidity issues, maybe even facing default. And second, that SOHO China believes that even in Beijing and Shanghai, there is simply very little appetite for more real estate, for purchasing of real estate, particularly at the current, most likely bubble prices. Indeed, we have known for years that office space in particular, and especially in these tier 1 cities like Shanghai, Beijing, Shenzhen, Guangzhou, etc., have both very low occupancy rates and very low rental yields. On Thursday, SOHO China's CEO Pan Shiyi explained debt issues are forcing SOHO China to sell some of its properties on discount, adding that, quote, "There is nothing that can't be sold, only prices at which nothing will sell at." However, even with a 30% discount, domestic analysts are skeptical as to whether SOHO can sell these assets. Analysts with Beijing Business Today expressed that SOHO China may struggle to find buyers with the current market conditions the way they are. Indeed, they published an article yesterday titled, quote, "Who's going to buy SOHO's bargain bin buildings?" End quote. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.